Hi, everybody. This is Doug English and Wes Johnson with Act Advisors. We've made this video to help explain our investment committee process. Now, Wes is the leader of the investment committee, and I'm going to interview him for you to help explain our process. So, Wes, tell us a little bit about what you do each day in preparation for the research call, about the research call you participate in every day, and then we'll talk about some of the other things you do.
All right. So one of the many places we get research from is LPL Financial. We also get it from Schwab and a number of resources. But the most detailed information we get is from LPL because their research department hosts a call every morning, and there's a different topic every morning. I generally start my day with reading some of the other publications out there and tracking some of the indicators that we track internally. And then at 8:45 every morning, there is a research call. It follows a very strict cadence. Every morning, every day of the week is a different topic. I'm on that every day. The Monday call is, they call it Macro Monday. They look at macroeconomic issues. The Tuesday call is Fixed Income Tuesday. I know for a lot of folks, bonds don't seem that exciting, but the bond market is much more complicated than the stock market. So the Tuesday call with fixed income, it gets pretty deep.
When you need them, you're glad to have them.
Yeah, because that would be too much for us to do ourselves. Wednesday is the manager and models day. It's when LPO shares any trades that they've made in the models that they manage. And sometimes we will mirror their trades and their allocation. Sometimes we don't, but it is helpful to know exactly what they're doing in their models. Thursday is Global Thursday. It's where they bring a few international experts onto the call and talk about what's going on in the world and how it might relate to your portfolios. And then Friday is all technical analysis. Technical analysis really follows chart patterns. Are we still in a trend channel, or have we broken out of that channel and now we're into a different trend? So it helps us get our arms around, are the moves that we're seeing just regular moves in the market, or is it potentially a new direction the market's going to go in?
So let's back up a bit and explain how this affects the clients of Act Advisors. The things that you're describing, the models and the managers and the selections, how does a client of Act Advisors experience those decisions?
So the only way we can really manage individual accounts is if we assign a model and we're managing that model. So all the Act Advisors clients, are assigned, every account is assigned to a model, anywhere from 100% stocks all the way down to zero stocks and everywhere in between. So let's take our 60/40 model, which is the most common risk level for Act Advisors clients. Everyone in a 60/40 IRA account gets the exact same trades across the firm. So when we're taking in all this research from the various sources, we're building out the firm's models, and those models are what everyone's clients, every account is in. There are some different variations of the models, but for the most part, they all follow the same trades.
So you are placing the trades for all accounts across the firm, and you make variance from some accounts that have maybe a tax reason they can't get out of a position, but I think the important takeaway is you're the sort of the man behind the curtain, the person pulling the strings on. When a client sees a trade in their account, you might wonder who's doing that. Who's doing that is almost entirely Wes. So tell us about the difference between the models you built for IRA and qualified accounts versus the models that you built for taxable accounts.
So, IRA accounts, they're easy because we don't cause our trades don't cause tax consequences. Those accounts, whether it's a traditional IRA or a Roth, they're tax deferred. We can trade things with no tax consequences. So those are much easier. A non-retirement account, which we call a taxable account, we call it because anything that happens in that account is a taxable event. So if we sell something that has a gain, you're gonna get a tax bill for it. That's a capital gain. You're gonna get a 1099 at the end of the year showing the capital gains. It's gonna cost you money. So we have to manage those very differently than we manage the IRAs and the Roth IRAs. So if there's a trade that we feel very strongly about making in the non-retirement accounts, we will go through and calculate, here's the capital gains, and we'll go through every single one. and make a decision. Does that account get the trade, or do they get part of the trade so that not as much capital gains, or are they okay with this amount of capital gains? So there's the non-qualified accounts, we do a lot of work to make sure we don't hit the clients with excessive tax bills.
Yeah, I always like to tell people we know for sure you're going to pay the taxes. We don't know for sure what the trade is going to result in. Of course, we research it heavily to have it be the best possible trade. But the tax part, well, that one's going to happen, right? That one's going to happen for sure. So we covered that the models are across the firm, that you do basically all the trading that occurs in our client accounts. What is the process internally? You talked about your participation in the daily research call, the various subjects that they cover each day. But talk a little bit about our internal process and then your meetings with external firms.
So internally, Activisors, we have an investment committee and we meet weekly. And we discuss all the research that we've been accumulating over the week. We also do a more in-depth call once a month where we're benchmarking our models versus the various benchmarks. But it's basically a committee that makes the decisions on what trades are we going to make. It's not just me deciding, all right, we're gonna put this in the portfolios. We have a committee. We have a lot of times in that committee, what we're doing is we're setting if this happens, then we will move into this area. We're setting requirements to make changes. So we're constantly having what if scenarios in our investment committee meetings to, just to get ahead of and make sure we're not surprised by anything going on. And then as far as outside meetings, the entire Wall Street world offers various investment products, and they send sales folks out to us for lack of better terms, to pitch investment ideas. And we do listen to those pitches. The vast majority of them we dismiss, but they have huge research departments in their back office. So some of them will bring some pretty interesting viewpoints, and they'll bring up things that maybe our other research partners have not mentioned. So it is helpful to hear all those. We want to stay up to date on the latest investment products that are out there, the latest structures to get into different asset classes. And last year, probably the far and away the most common thing that we were presented with was private equity or private debt. And we had always resisted those two areas because they're not liquid. But in recent years, the Wall Street companies have come out with what they call liquid versions of these. They're liquid every quarter, so you can get out of them every quarter. But now what we're seeing this year is that doesn't work that well. I mean, just imagine, a bunch of people locked in a room and they say, we're going to open the door for 1 hour. As soon as they open the door, everybody tries to run out of it. So what they've done now is they've said, well, I know we said you could get out every quarter, but only a little bit of you can get out. You can't all get out. So
maybe that's an opportunity to back up into a philosophical position. Like, you're getting pitched constant investment ideas from everything you can imagine. How do you filter? What are the key characteristics you're looking for? What actually makes it into client portfolios?
So we start with cost and liquidity. Everything we invest in needs to be liquid daily. And it also needs to be low cost. Now, there are some exceptions to the low cost. In the stock side of the portfolios, low cost almost always wins. So the vast majority of the investment vehicles we use on the stock side of the portfolios are extreme low cost passive investment vehicles. The bond side's a little bit a different story. It is not difficult for an actively managed bond fund to beat the bond index. So if we would just bought the cheapest bond exposure we could get, we could just buy the bond index. And sure, we would keep the costs low. But if we buy an actively managed bond fund, as long as the return after their expenses are meaningfully better than the index, then it's worth it. And that's where we're willing to go up a little bit on the internal expenses, is in the bond side of the portfolio.
Yeah, we only are willing to spend your money if the results that the manager has produced are consistently exceptional, and we continue to believe they will be able to exhibit those characteristics. Now, in closing, we do a meeting twice a year. We call our annual outlook and our mid-year outlook. In that meeting, which we strongly encourage you to attend, Wes and I will unpack what has happened in the last 6 months, the trades that we've made, what's going on in the markets, and then maybe more importantly, what we think is coming in the next 6 months and the trades that we may need to place in the portfolios to advance and potentially protect your assets. So with that, thank you for listening. Thank you for your business. We'll talk soon.